welcome to Chapter 14 of Modern Business Accounting Principles. And just a reminder before we get started, this text is copyright 1936, Alexander Hamilton Institute. And this week we're digging into provision for depreciation and other reserves. And it's going to be quite a short chapter just because depreciation really is more of a big business thing with the small asset write-off. We often don't really get into depreciation. Most businesses that I deal with are really cash operated and cash driven and not really using many of these non-cash transactions. So it's still important to know what depreciation is in order to work out if it would apply to your business. So we're going to read through the chapter, and I'm going to read quite a lot of the beginning of the chapter because it's actually a really good explanation of depreciation. Some of the figures are way out in terms of the value of property, but remember it is 1936, so property may have been available for £20,000, and this was before Australia was converted to dollars. So, the meaning of depreciation. Depreciation is the term commonly applied to the decline in value of fixed assets. All physical fixed assets, with the exception of land, ultimately become worthless and must be replaced. They may be used up in a fairly short time, or they may remain in service for a great many years. In either case, the value of an asset decreases during the period that it is used by a concern. So what's a fixed asset? Well, a fixed asset could be pretty much any item. Generally, you aren't going to do depreciation on something that's used up within 1 year because that's one accounting period. So you're looking for equipment, tools that are going to be used by the business for a period longer than 1 year. So buildings, equipment, that's the main ones that come up. So the example, a building that costs £20,000 may be used for 20 years and then dismantled to give way to a new structure. If materials salvaged from the old building are sold for £500, the total depreciation would be £19,500. So a concept that is still there in depreciation and still current today is what will the value of the asset be at the end of its useful life. So not all equipment is just completely obsolete, completely dead, and the whole value consumed. You may be able to on-sell the car, so maybe you keep it in your business for 5 years and then you sell it on or trade it in for another newer vehicle if that's appropriate for your business. So the value at the end of its life shouldn't be depreciated because it still has that value. So this represents an expense of the entire 20-year period, just the same as the cost of fuel consumed is expense charged of a single accounting period. Depreciation is an expense charged measured by the amount of fixed assets consumed. Stated in this way, it appears to be a very simple matter, but in actual practice it constitutes one of the most difficult problems in accounting. So depreciation is complicated, and there are a lot of guides and references available from the ATO's website. So the ATO actually supply lifetime estimates for equipment. So if you buy a fridge for your office, the ATO can give you a guide on how long they expect that fridge will last, which will help you work out what depreciation to charge each year. So the difficulty arises chiefly in determining the amount of depreciation that may be properly charged to the expense account of each accounting period. It is a very simple matter to say that the total depreciation of a building is £19,500 at the end of its service life. But it is quite a different matter to determine at the end of each year during its life just how much should be charged for depreciation. And this is exactly why the ATO produced these guidelines, because they don't want wildly different depreciation being used by companies. So if two companies buy the same fridge and use it for basically the same thing, they don't want one company to say, well, this fridge is only going to last 2 years, and another company to say this fridge is going to last 10 years, because that's going to provide wildly different impacts on their accounting. So if the accountant knew definitely the exact date in the future when the building would be dismantled, and also the amount of salvage value, she would have very little difficulty with the depreciation problem. These two important facts, however, cannot be known definitely until after the building has ceased to be used for production purposes. In other words, the exact amount of the total depreciation and the length of life are not known definitely for 20 years. Income statements and balance sheets must be made up at the end of each year, so it becomes necessary for the accountant to make certain estimates of service life and salvage value as the basis for the annual depreciation expense charge. And that's something accountants do, and it's quite a normal process. It's done a lot. So if you do have something that will be depreciated, please just discuss that with your tax accountant and they can assist you with finding the right depreciation rate and the right depreciation method. So, factors of measurement. There are three important facts that must be determined before the exact amount of depreciation is known, namely the cost of the asset, the length of its service life, and the residual or scrap value at the end of its useful life. So the first of these, the amount, the cost of the asset, is the only definite known quantity at any time during the life of the asset. It is necessary, therefore, to estimate the other two elements in order to apportion the total depreciation expense to the annual profit and loss statements. This may appear to be a mere guess on the part of the accountant, and it's not a guess, but maybe an educated calculation. Let's assume, for example, that some equipment is installed in a factory at a cost of £10,000. The accountant estimates that it will be in service for a period of 15 years. At the end of each time, it would have a scrap value of £1,000. This means that she estimates the total depreciation at £9,000, and this sum must be spread over the expense accounts for 15 years. And there isn't really a way to check these figures. You can estimate, you can use the guides, you can obviously discuss how long equipment is expected to last, but there's also factors around obsolescence. So not all equipment is valid forever. You may invest in a new computer to do something specific, and then a better computer comes out that does it even faster and more productively, saves you time and money, so you're probably going to upgrade to that computer, so the original one actually becomes obsolete. And this happens a lot with software and big machinery, and particularly with new technologies. They turn over so fast sometimes. An estimated useful life is just a guess because the obsolescence happens so frequently. So then, the chief cause of depreciation are wear and tear from use. And this is what depreciation is trying to do. It's trying to allocate the cost of using an asset to the production of income. So income's produced from this asset over a number of years. So therefore the expense of using this asset should be allocated where the income is produced. So we're trying to apportion that amount into the periods or the financial years, as in this case. So once we've determined what the asset cost, and that includes the cost of getting it into service, the useful life and any residual or scrap value, we also then have to determine a depreciation method. So there are several methods of computing the amount of depreciation charge to be made in each accounting period during the service life of a property item. The problem consists in determining how much of the estimate for total depreciation should be allotted to the expense account of each year. And as ever with accounting, there has been a great deal written on this subject from both the theoretical and practical points of view. And there are 5 standard methods that have been evolved from a great number of suggestions made by many different writers. So, accounting interests everybody. So the methods are the straight line or fixed installment method, and that still does exist and is widely used today. The fixed rate on declining method, again, very much used still today. The annual revaluation method, which you can use, but it's really hard to determine that value if it's an asset that you're using that doesn't have a market value. The depreciation fund method, and then the annuity method. Now, I won't go into details on each of them because this will get to be the most dry video so far, and there's been some pretty dry chapters. But to say again, the ATO do provide guidance on this, so they will provide guidance on which method they advise, and if you don't know any better, you really shouldn't be arguing with the Australian Tax Office. The straight line method is the easiest because you just say, you know, this asset was $10,000 and it's going to be used for 10 years, therefore it's $1,000 a year. There's no scrap value. That is the most straightforward, but it's not necessarily the most accurate. Like a car depreciates at a different rate. It doesn't equally depreciate because as soon as you drive it off the lot, you lose a lot of its value. So there are methods to accommodate that sort of change. So if we skip over the very detailed description of them, we also come into problems with other assets. So it's not always a fixed tangible asset. It's not always a building or a piece of equipment or a car. We also sometimes have intangible assets such as trademarks, patents, rights, etc. that are considered in the group of property items that are subject to depreciation. It is true that they are not subject to wear and tear from use, so you don't wear out a patent. Yes, a patent has an expiry date, but you don't wear it out as you use it because it's intellectual property. It's not physical, tangible property. But their values do change. Patents and copyrights are granted for definite periods of time. The cost of acquiring such rights should be amortized or written off the books in the same way as depreciation of tangible assets. All such intangible assets should be written off according to the number of years that they are expected to contribute to the earning capacity of the enterprise. So it's just the same concept as a tangible asset. So if we have a piece of equipment that's going to produce products for 5 years, we may also have a patent or copyright for 5 years. So they are producing income within the business over the same period of time, even though we have a physical asset and an intellectual asset. There's also goodwill. So if you do purchase a business, goodwill is something that you buy from the previous owner. So it's about customers and relationships and the value of the business over its assets and liabilities. So you can then, when you buy a business, have a goodwill asset which you may decide to depreciate or amortize. There's also depletion of oil mines and oil wells, or mines and wells, but we'll not get into that. We will just go and touch on accounting for depreciation. So up to this point, our discussion has been concerned with the methods of determining the amount of depreciation or value decline of assets. These are the most difficult questions involved in the depreciation problems, but the methods of recording the data are also of significance. There are two methods of entering depreciation in the books. One of these is to debit the expense account and credit the particular asset account. And there's an example, it gets very technical. The other method of entry will be to debit the depreciation account, expense account, but to credit an entirely new account called provision for depreciation. And it's just a very technical way of saying you either reduce the value of the asset or you actually create a second account for depreciation of the asset, which is done more often because then you have the correct value of the asset. So if you did buy a car, $50,000, you don't want to be adjusting the value of that vehicle. We actually want to be saying this is what we have provided as depreciation for this vehicle. Then we talk about provisions for doubtful debts, and if you aren't using credit with customers, you're probably not going to need to provision for doubtful debt. And then we talk about reserves or provisions, which are effectively the same thing, but the book is trying to be fully transparent on the different ways that people use the terminology, reserves or provisions, and then some nice tables in here showing the comparison of different depreciation methods. And when you learn depreciation, you do go through these comparisons of straight line and reducing balance and revaluation, and it's all fun and games, and it's much more interesting than this video. So we're going to leave it there. Next week's chapter is appreciation and depreciation, because we haven't apparently covered enough depreciation yet. I hope you come back and stick around then. If If you do want to be reminded when these videos are released, hit the subscribe button for the channel, and I'll see you next week.